Good evening, everyone. Thank you for waiting the whole 3 minutes for us. I just wanted to give everyone ample opportunity to get into the session before we begin. So everyone, thank you very much for taking the time to join us today. We have audience members from across the world. I see people from South Africa that I know very well, and I also see that there are people in Europe and also some in Australia. So wherever you are in the world, be it early, be it late, thank you for making the time to be with me this evening. I'd just like to give out a special welcome today. We are joined by His Excellency, the High Commissioner of South Africa to Singapore. I would like to just give you a special thanks for giving us your time, sir, and for joining us this evening. I appreciate your support. Without further ado, everyone, we can proceed with the event. The title for this evening is How to Take Advantage of the Unexpected and How to Leverage on Market Volatility. As we all know, last year was an incredible year, not only for financial markets, but also just, we all went through a lot, didn't we? So I'm quite pleased to be through it and on the other side of it, but unfortunately, COVID is still with us. We're now just going to go through a little bit about who I am. And why you should be listening to me in the first place. So I'm an associate partner at the Heritage Partnership, which is a partnership practice of St. James's Place. We'll get more into that in just a bit. I'm a board member with the South African Chamber of Commerce here in Singapore. I'm very involved with the South African community here. I really love trying to give back to the community as much as I can. Originally, I'm from East London in South Africa. Not the east of London, but East London. It's quite far removed. We have sunshine and beaches down there. I actually did go to school. I went to university, actually to two universities, Nelson Mandela University and the University of Free State, both in South Africa. On my journey to getting out here to Singapore, I became UK qualified as a wealth manager, and I also am licensed in Singapore to give financial advice. I have my capital markets financial advisory license here. Please excuse the ugly picture. They made me just pick one to use for today. So in terms of our agenda for today, we're just going to have a little bit of an introduction. We've now finished the welcome. A little bit of an introduction to the Heritage Partnership and St. James's Place. We'll then get into the crutch for today, which is essentially discussing the market crash and market recovery last year. What were the sectors that contributed to this, which flourished and which perished, and why? And we will then go into the first Q&A. But just a bit of housekeeping. You will see that there is a question box on, I believe it would be on your right-hand side. And please feel free at any time to pop questions in. I've got the question box open on my screen right here, so I can see when they come through, and I'll try and address them right then and there if I can, or I'll get back to them during the Q&A segments. After we've been through the Q&A segment, we're just then going to be looking at the practical ways that you can actually benefit from market volatility. So it's all fine and well for me to tell you what happened, but how can you use that to your advantage going forward? That's what we're going to be discussing this evening. And then we're going to use a real live case study that might be quite surprising to a few of you on the call. And then we'll have our final Q&A and closing thanks. So without further ado, we're going to get into who is the Heritage Partnership. Essentially, the Heritage Partnership is my team, the guys that I work with. We are a partner practice of St. James's Place. So we're still a part of the group, almost a division of, you could say. And essentially, because our team has grown to be the second largest partner practice in Asia, this allows us to form our own identity, hence the name being separate. What we specialize in as a group is essentially goal-based financial planning, where we work with our clients in depth to understand what their goals are and how we can get them closer to that, what milestones we can set in place, and help them, be it quarterly, biannually, or annually, to ensure that they are on track to reach those goals. What you'll see there is our 4 pillars and what we stand for. Now, in terms of who is St. James's Place, here you go. You can see that St. James's Place is a UK-based wealth management company, but we have offices throughout Asia, in Hong Kong, Shanghai, and Singapore. We are a FTSE 100 company, meaning that we are in the top 100 financial institutions in the UK. We have 760,000 clients worldwide, and currently we are managing $235 billion of their assets. Part of the reason why people put their money with St. James's Place has to do with our distinctive approach to investment management and also our commitment to our clients. So the best way to put that in practical terms is our client retention rate throughout 2020, which, as we know, was a difficult and volatile year, was 96%, which is unheard of in most industries and especially in ours. So I'm quite proud to represent St. James's Place. So without any further ado, that is all the formalities, the housekeeping, the introductions and welcomes. Let's get into it. So what you can see here on this graph is the S&P 500 from 2019 until March 23rd, 2020. What is important to note, and what this graph is here to illustrate for us, is essentially the speed at which the markets fell. The market lost almost 40% in a very short period of time. We're now going to explore the contributors to the crash. So what's remarkable about that, and when you see the sheer drop off the market, is that it only took 22 days from the 19th of February to the 23rd of March, 22 trading days, for the markets to crash and lose what was almost 40%. This is absolutely unheard of. It's actually the fastest drop of this magnitude in history. There are only two other days that are of similar nature in terms of the magnitude of the drop, and that is Black Monday of 1987. Some of the older folk on the call might recall 1987. It was a very dire year for financial markets around the world, especially the US, with a lot of stockbrokers throwing their telephones out of skyscrapers' windows in New York. And then second to that was December 12th, 1914, which is essentially when World War I broke out. So what happened last year and the magnitude of the drop is almost comparable to that of what happened during a world war. Yeah, it's just astounding, right? So in terms of what were the contributors to this, if you look at the middle block directly in front of you, you'll see that the drop was caused by fears of coronavirus. We have heard about coronavirus ad nauseum. Today, I'm not going to lecture you about the virus. I'm not going to give you any statistics. I'm not going to talk any further about the virus because we've had enough of that. What I'd rather like to focus on is two main contributors to the crash, which is essentially crude oil and US unemployment. So please, as we're going through this, and we're going to be going through quite a lot of detailed information regarding crude. I know I have a few oil and gas and energy guys on the call. I would love to hear some of your feedback regarding what I'm about to tell you. So please feel free to pop any questions, comments, or anything into the question box, and let's make this as interactive as we can. So what we're now first going to look at is the crude oil crash and the contributors to that crash. And as you can see, it is as drastic, if not more drastic, than the S&P 500 market crash that we just had a look at. So it's very important when you're looking at this graph. I want you just to look closely at the dates. So what we have is, if you had to look at February, and then you just go to the midpoint of February where the massive steep decline in a short area was, so mid-February. And then in March, it's almost in a series of days, in almost 3 to 4 trading days, you can see what has happened. So this graph is running until the 23rd of March as well. So now we'll get into the contributors and what happened on those days. But please just remember what I just outlined in terms of those drops. Call them intervals, if you will. Obviously, due to one of the greatest contributors to the crash in crude was the coronavirus. We know that demand for travel and factory activity was basically overnight halted. But further to this, the International Energy Agency, they forecasted that the oil demand growth was to be the lowest that it would be since 2011. Let me take you back to 2011. We had civil wars in the Middle East and Libya, and what this did was essentially it caused the oil supply to be drips and drabs. So we are now comparing what happened with COVID and the demand for oil to essentially a civil war that happened in 2011 in North Africa and the Middle East. Now that's exactly on mid-February. That's when you saw that initial steep drop. Of course, OPEC now calls a meeting, and they're calling all of the greatest producers of oil around the world to have a discussion about production and how they're going to manage the fears around coronavirus and the decline in demand for oil. And on the 6th of March, OPEC and Russia, they fell out of agreement and they couldn't agree on production cuts. And what happened the very next day is that both Saudi Arabia and Russia both announced increases in oil production. That same day, the price in oil dropped 25%. So just think about that. Demand has absolutely slumped due to coronavirus. Factory activities are basically stalled. Travel has stopped. Airlines are panicking, and they decide to increase supply. Basic economics, laws of demand and supply. Why would you do that? So further to this, on the next day, the 8th of March, Saudi Arabia decided to further undermine the Russians, as they hadn't yet reached an agreement and they had a great falling out. So they decided to increase production even further and to sell it at a discount of almost $8 a barrel to customers in Asia, the US, and Europe. Why would they do it to those specific areas? Because they are the greatest buyers of Russian oil. And the Saudi Arabians were essentially trying to cripple the Russians in this price war that they were having on their own. When you look at the graph and you see that it staggers down, down, and down over a series of days, that is the 6th, 7th, and 8th of March, that we saw the massive repercussions of this price war between the Saudis and the Russians. Unbelievable that they will do this during a pandemic. The second contributor to the crash that we're now going to get into and discuss a little bit is the US unemployment. So not only was the US unemployment levels at all-time highs, but global unemployment was actually on all-time highs. And essentially this is mainly caused by COVID-19 and the initial shock. And people didn't understand the long-term effect of the virus or how dangerous it actually is just yet. So essentially there was that massive upward spike. And this is best described in the US because in March 2020, unemployment was 4.4%, and in April, it was 14.7%. In the space of a month, one of the biggest economies in the world, if not the biggest, lost 10% of unemployment. So that means they went from 4 to 14%. It's just a massive amount of people without work, panicking, holding on to every dollar that they had. This sent absolute shockwaves through the population. People were not certain of where their next paycheck was coming from. And as such, they pulled out any investments, any savings that they had, and they held on to every dollar that they had. The next slide is going to show you exactly just how astronomical this drop in unemployment was. So what this shows is two lines. The top line is permanent jobs, and the bottom line is temporary jobs. Temporary jobs are people in the gig economy, for example. What you'll see is that in March, you see that massive spike. And this graph runs all the way until December 2020. The temporary jobs is actually what was lost on a massive scale. But just as fast as it went up, you can also see that it went down. So what I really want you to focus, and what's really interesting, if you can focus on the top line, and you can see that it actually only kicks up about 4%. Now 4% for permanent jobs in America, an established economy, in a very short frame of time, it's still a big number. It's a lot of people who lost their jobs. However, if you can follow that line back and you can see what happened in the global financial crisis in 2008, look at that level of permanent job loss. Do they really compare? Were people initially overreacting? What do you think? Now, my question to the audience at this stage regarding the US unemployment, when you look at this graph and you focus on permanent unemployment, and you make that comparison from 2008 and 2020, what do you think this means? If you could just pop some answers in the question box, I'd love to hear your thoughts. Let's not all go at once. Oh, I've got one coming through, thank you. Yes, okay, all right. So essentially what this person has said in the box is that if you look at how long it took for unemployment to recover from 2008, perhaps it won't be the same case for recovery from the 2020 permanent job loss. It's a good observation, thank you. Okay, that's the only one we're going to get then. So when you're looking at this, you'll see that just as this person has rightly said, you'll see that it was a massive spike in 2008 and it went all the way until 2015 before it had reached pre-2008 levels. That is a very long time for unemployment to normalize again. So the fact that we have already seen it go up, plateau, and come down, I think that's brilliant. It means that the recovery of employment is going to be far greater than what it was previously in previous years. Okay, we've got someone who said this is the potency of Donald Trump's excellent leadership, perhaps. Yeah, that's the only one. All right, guys, look, please keep the comments coming. I'm going to just move on to the next slide. We can always come back and discuss this. But now we've basically been through crude oil and we've been through the unemployment. Now, these are two factors that massively influenced the market crash last year. The next thing that we're going to get into is what were the biggest sectors that lost the most during the market crash. Some people call them losers. Some people can call them opportunities. My question to you is, why are they opportunities? Right? Okay. Someone has put in volatility. That's why there's an opportunity. Right. The thing is, when these shares have fallen, perhaps they're a value buy. Maybe they're selling cheaper than what they usually would. Perhaps they present an opportunity to buy in and get the recovery with the share. If you look at these three pictures, and after what we've just described in crude oil, I think it's no surprise that energy is one of the greatest losers of 2020, and so is leisure and travel. Now, when we look at crude and energy, again, it should be no surprise that 6 out of 10 of the biggest losers on the S&P were energy. What is amazing about this, and I've only highlighted, look, there's a lot of oil companies out there, but I've only highlighted 3 that I think most people would know or may resonate with them, and that is Chevron, West Texas Intermediate, and ExxonMobil, each of whom lost between 20 and 30% during the course of the year, which is, even though there was a slight recovery, it was still, the West Texas crude was still down 21% for the year. So is this an opportunity? Is it? How long is it going to take for demand to kick up to the level where oil can actually recover? How long is it going to take for factories to reach full capacity again? How long is it going to take for travel to start using, and aviation to start using the same levels of fuel that it was? Perhaps a long time, perhaps a short time. But what the next question you may ask is, are you telling me to buy oil? Look, if you can sustain a long-term horizon and you want to take that risk, we don't know when this is going to recover. We don't know when this is going to end. That would be completely up to you. Moving away from energy, we've heard enough about oil now. Travel and leisure are the next two. It should come to also no one's surprise that cruise ships did poorly. Let me bring you back to about January 2020. I'm not sure if you can recall, but during January 2020, COVID-19 was initially, there was no massive outbreaks on the cruise ship, okay? And they were unable to dock back in their initial countries. So we had people stranded at sea on the cruise ships with coronavirus, being unable to return to a country that they were meant to be going to their destination. So we had people going into Myanmar and Cambodia, and they were literally sailing around the world looking for any country that would take them. This is evident when you look at the two worst performing stocks last year, being both cruise ship operators, down 59 and 58% respectively. Unbelievable. Now, the most famous of all the cruise ship liners is the Royal Caribbean, which also was the 10th worst, down 47%. They were down 47%. And that is after a massive Q4 surge. And it's after a massive Q4 surge of 9.2%. They were still down 47%. Again, it's no surprise, cruise ships didn't do so well. United Airlines and Marriott. These now fall into international travel and leisure. United Airlines International was down 50%. Marriott was down 14%. Now, there's just a question that came through. It says, you said that these are industries for opportunities, but how do you tell if a company like Marriott or United Airlines is worth buying? Okay, so yes, these are the losers, but like I said, they could also potentially be an opportunity. How do you establish whether or not they are an opportunity? You have to now go back to company fundamentals. You actually have to look at what is the company that you would be investing in. Yes, they're going through a hard time, they're going through a pandemic, but do they have the fundamentals that they could survive this? And if they can survive this, how long will it take for them to recover so that you can gain in profit? So if we then, you mentioned Marriott. If we look at Marriott, okay, Marriott International is a global hotel brand. I'm sure lots of us here have spent a night at Marriott. I'm looking out my window and I can see Courtyard by Marriott here in central Singapore. This company has over 6,900 properties across 130 countries. Very geographically spread out, very robust net asset position. Will it recover once the COVID has passed? Most likely. But when you are looking at which companies to buy, you should definitely be looking at their net asset position, their underlying assets, and what could their revenues be, and how long would a recovery take before you would make a gain. However, if we then look at United Airlines, for example, that's down 50%. United Airlines is facing not just coronavirus, but also Boeing 747 MAX problems. The Boeings were crashing out, and people obviously don't want to fly on a plane that's going to fall out the sky. So now the question comes down to, yes, pre-COVID, United Airlines had a revenue of $40 billion or more in 2019. But because it's facing two problems, are these enough to cripple the company permanently? Or are the solutions, such as the vaccine and Boeing solving the problem of the 747, are they close enough to support a recovery in a time frame that you could realize a gain? Again, these are things that you would have to do your research on and decide. Now, there were many losers for last year, but these were just the ones I wanted to highlight, being energy, travel, and leisure. All right, sorry, I just saw we got a question. Keith, thank you very much. Sorry you have to leave. Thank you for attending. Appreciate it. All right, so moving away from what were the contributors to the fall in the market, we saw what contributed to the fall, what contributed to the recovery. When you look at this graph, just as fast as it went down, it came back. It took 22 trading days for the market to go from a high to a low. It took 21 weeks for it to fully recover and reach a new all-time high. Unbelievable. So just as fast as it went down, it went up. 23rd of March was the pit, and on the 18th of August, we had an all-time record high again at the peak. What were the contributors to this recovery, in your opinion? Which sectors helped pull the markets back up? Shipping and freight. Okay. I would say on a smaller scale, think wider. Think about the main things that shifted, that made us continue with business last year while stuck at home, for example. E-commerce, yes, very good. E-commerce was definitely a contributor. Now, e-commerce is a very wide platform. You have people selling things on one platform. You also have people paying for things on other platforms. Think about that with e-commerce. It's the buy and the sell. Yes, tech. Tech was definitely one of them, from Zoom, Microsoft Teams, Amazon, anything technology-based definitely helped. Alcohol. You know, in South Africa, they had a ban on alcohol, actually. You couldn't purchase alcohol during parts of last year. And actually, as of yesterday, they just relinquished another ban. So we have e-commerce, alcohol, shipping, freight, tech. And what about this magical thing they want to put in us to make coronavirus go away? All right, let's get into it. I'll get into all the contributors now. So the top 3 leading industries essentially that pushed the market to recover as fast as it did: pharma, the race for the vaccine; technology in all shapes and form; and e-commerce. So we can't go through a review of 2020 and not talk about the vaccines. The race to develop the vaccine led to many companies surging, such as Moderna, Pfizer, AstraZeneca. And on the next slide, you'll see just how well Moderna did. Moderna was up 530% at the end of the year. They were the second best priced on NASDAQ 100. So the performance is unbelievable, 530% in a year. Look, there were also, just as there were many losers, there are many winners. But I've only chosen 3 here that we could really go through, that we could relate to from each of the different sectors. In the transition to working from home, anything that made our lives easier for working from home did really well. So think about what programs you use every day for taking your meetings. Microsoft Teams. When you're having your Christmas dinner alone in Singapore, away from your family, what do you use to talk with them? Zoom. I had a Christmas call on with my family using Zoom. And it's no surprise that Zoom did absolutely phenomenally last year. It was 451% up, and it was the 4th best on NASDAQ 100. Unbelievable. But just as we mentioned e-commerce, and yes, you need a platform like Amazon to sell a product, you also need something that is safe and secure to help with online sales. So any business or any product that assisted with continuation of business practice did really well, such as e-payment systems and contactless payment systems. So PayPal is no surprise. It is already established as one of the leaders in payments solutions. It was also started by a South African named Elon Musk. It's no surprise they were up 120.6%, and they were 4th on the S&P 500 at the end of the year. So here we've now been able to see these are just 3 areas that contributed to the massive uplift that we saw last year. Moving on, we're going to be talking about commodities. Oh, I just got a question. Are you telling us that it is a good idea to buy PayPal, Zoom, and Moderna? So let's just go one slide back. Am I telling you to buy these shares right now? In my opinion, for example, Moderna, they made a race to get the vaccine, and on the back of hopes that this vaccine could cure COVID-19, they surged 530%. However, do you think in 5 years' time, this trend is going to continue? They are going to continue to grow every year, 530%. Is there going to be a COVID-19 to fight every single year for the next 5 years? Perhaps no. Perhaps these are cyclical, seasonal, due to the issues that they're facing. So again, take all of this with a pinch of salt, as it is a review of 2020 and it's not looking forward for 2021. Back to commodities. We can't have a review of 2020 and not talk about gold? What you can see on this graph is three things. The black line, which is massively underperformed and has stayed down, is crude oil. As we've discussed already, crude oil hits the bottom and it has stayed there. There's been a slight recovery, but until global demand picks back up, it's most likely going to sustain the level that it's at. What you also see is a yellow or gold line, which is gold, and a orange or copper colored line, which is actually copper. What I wanted to touch on when we're looking at this is, why did gold have a good year? Did it really have a good year, or is the dollar simply weak? Now, let me explain to you what I mean by is the dollar. The US dollar has long been the world currency, right? The biggest transactions in the world often are crude oil. They are bought and sold and priced in US dollars. With the demand for crude being down, that means these sizable transactions are also down, which means that the demand for the dollar is down. Not only that, but there was the massive unemployment that we just spoke about. With the unemployment being down, the demand for a dollar was also lower because people weren't going out and spending every single dollar that they had. They were holding on to it. Further to the US dollar, there was massive monetary stimulus coming from the Federal Reserve to prop up the economy, to keep everything afloat. During the course of last year, the Fed pumped in more than $6 trillion into the market. So as we've just addressed, the demand for the dollar is low, but then the Fed increased the supply of the dollar, demand and supply again. So that means that the dollar is substantially weaker than what it could have been. What does all of this have to do with gold? Gold is considered to be a safe haven. Gold is a value holder or a placeholder for value. When the demand for dollar goes down and the dollars seem to be weak, people race to put their money in something that is going to be protected against inflation, something that's going to hold value. And that has historically been gold. And that is actually, you can see, that's why gold sustained itself and increased. It is often a very volatile commodity, but last year, as you can see, it wasn't actually in comparison, for example, to crude. I've just got a question through here. When you get a chance, could you give us your thoughts on the impact of the Reddit brigade? Okay, in the Q&A section, we can talk about that. In recap of just looking at this graph, you've seen three things, but the two that I want you to focus on is, yes, crude is down, yes, gold is up, but is gold doing well because there's a massive demand for gold, or is it because there's a weak dollar and hence there's demand? How long can that be sustained? When crude oil picks back up, when the demand for dollars increase because employment is going to taper down, as we discussed, is gold going to remain as strong? Is it still going to be a value holder? Potentially, is this why cryptocurrency is also surging unbelievably? Just in the last quarter, it absolutely dominated. People are now looking for alternatives to holding their money in fiat currency, in dollars, for example. They will look at a value holder such as gold, fiat cryptocurrency. I hold a few cryptos, so I'm a little bit bullish on that. Essentially, that brings us to the close of the review section. Look, I know I'm talking a lot and it's a lot of information. I've put so much time and effort into this research, and I really hope that you've benefited so far from it. So if we just quickly recap, we went through the market crash, the contributors. We understood more about crude oil, unemployment. We then looked at what were the biggest losers and the sectors that didn't do so well. Do they present an opportunity? These were travel, leisure, and energy. Further to this, we then looked at what were the massive contributors to the recovery: tech, pharma, e-commerce, and then we just closed off on commodities. So please hit me with your questions, throw things at me. I'm going to be honest, I don't know what the Reddit brigade is, but I will look it up. That may be something recently that while I had my head buried in these elements, I didn't catch on to that. So I'll do some research. I'll look into it and send you an email afterwards. Any other questions regarding everything I've just been through? I'll just give you a few seconds to type your thoughts. send them across if you have any. Everyone, you've been great so far. Thank you very much for throwing in the few comments that you have. It makes the session a lot more interactive. I am aware I am standing in my living room in a suit talking to my computer. I hope you're entertained by that at least. Okay, we had a question come through. Okay, one of the questions is, what effect will the vaccines have and the rollout of the vaccines have on the market? We've already seen this in Q4. Part of the reason the Royal Caribbean shares jumped up 9.1% in the space of a quarter was essentially because people had the hopes when there's a vaccine that markets are going to recover, that leisure is going to recover, that these are an opportunity to buy. So we're going to now, in just a moment, be going through the behavioral science of markets and why they are inherently unstable. But to the question about the vaccines, is people were extremely optimistic about markets recovering as soon as they announced the vaccines. You saw that the recovery just spiked, markets ran massively because of the vaccines. So the long-term effect is, yes, they're going to continue to spike, but there will be a decline once we have all been vaccinated. How long that's going to take? What are the repercussions of vaccination? I'm sure we're going to get some bad news in the months to come. It can't all be good. Whatever company the bad news is linked to, it's going to cause them to obviously slump. No one's going to invest in a company that could potentially be hurting people. So bear all of that in mind. We've just had another one come through. The Reddit is about, this is about the guys that are shorting stocks and trying to break the hold that big trading houses have on trading of stocks, for example, GameStop. And now I see that they are going after silver. Look, any guys that are smart enough to take on the world's biggest institutions and beat them, they'll most likely be able to cause a demand effect into whatever they go into. They could cause it to go up or go down. This happened in 2011 with high frequency trading as well. There was one chap in his apartment in the UK who basically destroyed the New York markets. I think it's called the flash crash. And it would literally, in the space of 2 days, one guy in his parents' house, in his bedroom, crashed the financial markets around the world because he understood how high frequency traders were making their money. So my view would be, watch out. Overall, I'm not sure what the impact is. Again, let me do some research and I'll come back to you. All right, so we've now been through all of this, but what good does it do you for me to have told you all of this? How do you actually apply this? How do you benefit from market volatility going forward? How do you apply this to your own investments? That's now the section we're going to get into. Let's start with the first tip. And it sounds simple, maybe perhaps it sounds cliche, but simply stay in the market, stay invested. When markets are going down and they're going crazy, don't pull your money out. It's perhaps the worst thing you can do. And now let me explain to you why. And this is going to be coming back to more about the behavioral economics I briefly mentioned earlier. When you look at this graph, you'll see a roller coaster. You'll see emotions. And what it is basically mimicking is, in a market cycle, how do investors feel? And are they completely rational, or are they impulsive in their decision making, or irrational even? This brings me back to when I was in university and I was studying economics. One of my favorite theorems that we were studying was the Keynes economic theory, which believes that markets are inherently unstable. Why are markets inherently unstable? It's because of the human element. When you look at this chart, does that look stable to you? In a market, there are buyers and there are sellers, both of which are often controlled by people. This is where emotion comes in. And people do not ride this wave of markets, pits and peaks as smoothly as we would wish. We're not computers. We're not algorithms. So when you see your money going up and it's doing really well, you feel the thrill, you feel that euphoria. And then as soon as the market starts going down, there's a little bit of doubt. Perhaps it's going to crash. Perhaps I'm going to lose value. Or is it just another dip and it'll go back up? I'm going to wait it out. Eventually you get to the point of no return where you've waited too long and you've decided now, oh my goodness, this is the end of the world. I'm going to pull all my money out, and then you've made a loss. Now, when you're looking at this, essentially it comes down to two emotions: fear and greed. That's it. So yes, there are many emotions on this graph, but when people are in fear, they're going to pull their money out. When people are feeling the greed, they're going to put their money in. And also that's from a movie. I'm not sure if you've ever watched the movie Wall Street with Michael Douglas, but in that movie, it's a movie from the 80s. He literally says, greed is good. It's good for markets, it's good for businesses. That's where people spend their money. So that's the emotions. Now, further to my point, if we go to the next slide, you'll be able to see what happens factually in this scenario. So it's not just about the emotions, but what you can see here is the blue line being the MSCI World Index, and then the little gray blocks is actually the cash flow of mutual funds. So when the markets were going up and down, you can see that when the markets are going down, for example, in March 2020, look at that gray block. People pulled all their money out when it was already too late and the market was down. So this means that people were taking their money out at lower points to which they put it in. They made a loss. They realized a loss. Whereas if they had simply just held 2 months, look at the difference 2 months over. Look at what would have happened. They would have made their money back and then some if they held even longer. So as cliche as it sounds, don't panic. Stay invested in the market. If you can take a long-term view with any investment, you will always do well. And this brings me to the next tip that I have for you regarding how do you use market volatility to your benefit. And it refers to almost the same thing. Time in the market, not timing the market. And essentially what that means is you can't successfully time markets peaks and troughs over and over and over again, because as we referred earlier, they are inherently unstable because of the human element. Obviously, there are other economic theorems, but that's just one that I particularly enjoy. So this is best illustrated in a point form. Before we get to the point form, I have a question for you. In a volatile market, as what we've just been looking at, where there's pits and peaks, do you think it is better to invest a lump sum of money or to invest smaller amounts monthly? Tell us what you think. We'll just give it a few more seconds. We have someone saying lump sum coming through. All right. We have a few people saying monthly investments. Right, 70% of the audience has voted. Just give it a little bit longer. We also have someone saying a combination of both. All right, just a few more seconds. 90% have voted. All right, we can close the poll. So the majority of people on the call have said that a monthly investment is going to do well in volatile markets. One person in the chat box has said a combination of both, which is true to an extent. However, if you could just have one or the other, which would do better? Let me get into the answer and explain to you why. So as I explained to you, you cannot successfully time the market over and over again. For example, an investment that has a short term has far greater risk than one that has a long term. One way to reduce this risk is to actually just frequently invest into the market. By investing money into the market in this manner regularly, you use something called dollar cost averaging. Dollar cost averaging is essentially when you are buying units at different prices, and this is going to benefit you in the long term. This is best illustrated by an example, and now this is the case study that I was referring to. So what you'll see in front of you is the answer to the question. There are two lines, and what they are is the S&P 500. One, being the gold line, is someone who invested $90,000 upfront. The blue line is someone who has invested $10,000 a month for 9 months. The period of the investment is the 1st of January to the 1st of October. The time invested is the same. The amount of money is the same. The index is the same. However, who performed better? It's very interesting. The blue line significantly outperformed the gold line. So the monthly installment significantly outperformed the lump sum. And this is because as the markets were peaking and dipping, you were buying units. 1 month you bought units at a lower level, the next month at a higher level, the next month perhaps a lower level. But because you were consistently buying, you accumulated more units than a person who simply bought on January 1st. This is actually noticeable in the way of 6.3%. How do you make 6% more in the same frame, the same amount of money, the same index, to invest monthly. This is the phenomenon of dollar cost averaging. So I hope you took something away from that. But the actual question, the answer that we got that said a combination of both is completely right, because then you would have benefited from having a large amount of money in the market as well as having the regular contributions going in. This is a strategy that is best used not only in volatile markets, but perhaps when we are seeing more of a recovery. The combination of both is, we like to call that drip feeding, where essentially rather than putting all of it in at once, we put a large amount and we drip feed the rest through the volatility to try and get the best of both worlds. That was the case study. Moving on, there's obviously there are many more elements to investing that we haven't touched on today. There are many more winners and losers that we didn't get to talk about. We got to learn only two things, essentially: stay invested in the markets, and then also dollar cost averaging. Invest regularly if you can. More to this, there's a lot more that goes into successfully managing your own investment. This comes down to diversification, not only by industry, but also geographically. This comes down to the amount of funds that you hold in your portfolio, for example, or the amount of shares that you hold. If you have too few, you have concentration risk, where perhaps you lose value in one portion of your portfolio. So for example, if you hold 4 funds and one of them goes down, you've lost 25% of your portfolio. That's just an example. So there are many other things that come into play when you are investing in the market. If you would like to learn more about that, we'll have to get in touch and discuss your personal circumstances and see if you are ready to take advantage of the market volatility, and see if I'm able to assist you in figuring out what to do with your own investments going forward. If you just simply like to have a casual catch-up where we can discuss this, you can say yes or no, you can have a coffee, and it'll just be nice to meet all of you in person and to thank you for your support. For those of you that are based around the world, unfortunately, I'm not going to be able to get you that coffee, but if you ever come to Singapore, please do get in touch and I'd love to meet you. So the poll is open now. Please feel free just to say yes or no. It'll be great to get in touch with you. 30% has voted, 40%, 50%, nearly there, guys. 60%. All right, just one more minute and then we'll close this and continue. 70%. Very good. All right, 90% have voted. We can close the poll. All right, so after being through all of that, we have our final round of questions and answers. For all of you who've managed to stay with us throughout this hour, I'm grateful for your time. I appreciate your attention, and I really hope that you found value in what we've discussed here today. If I can answer any further questions for you, please pop them in the question box now. Oh, you're very welcome. I'm glad you enjoyed it. Thank you. Yeah, I'll see you soon. Great. Thank you so much. All right. Any other questions coming through? Let's give it a few more minutes. Love the session. Thank you very much. I've put so much effort into this. I'm glad you've enjoyed it. All right. Let's give it one more minute for any other questions coming through. There we go. If there was one sector you suggest investing in or looking at in the next 3 to 4 months, what would it be? It's a very good question. The next 3 to 4 months. Look, I'm not into speculation, so buying individual stocks and shares is not necessarily my forte. My own personal portfolio is very high risk, and I wouldn't advise people to take the same approach as me. However, sectors that are going to continue to do well are the same as what were last year. We're going to see tech continuing to grow and expand. We're going to see e-commerce continuing to grow and expand, and payment solutions continuing to grow and expand. What I would tell you to look at is, don't think about the obvious winners in the stock market. Try and think about the unobvious winners. So yes, within that sector, it's very wide. Don't just look at your Amazons, your Microsofts. Think out of the box. Don't just look at the US. Look for opportunities across Asia. Look at opportunities in Australia. Look at opportunities perhaps in New Zealand. But within the same sectors that did well last year, until COVID is behind us, perhaps that trend is going to continue. I hope that answers the question, but I'd be happy to catch up. We can have a wider discussion. All right. Well, that's all the questions that we've had come through, guys. If you would like to re-watch this, if you want to hear my South African accent more, please, you'll be receiving the recording. You can watch it over and over there as you please. And I've got one more question coming. We understand that monthly sums can get you further than a lump sum, but what's a good amount to start with? For that question, it all depends on what is your goal, your affordability, your budget, but I'll leave you with something my father taught me, which is the best time to invest was 20 years ago, but also today. So if you can get in the market in any way, shape, or form, you will most likely benefit. So my biggest tip to you would essentially just start anywhere with any amount that you can. Hope that answers it. All right, everyone, I know it's late. I'm sure you want to run off and grab your dinners. I appreciate your time. I appreciate your participation. Thank you very much. Please feel free to follow us on all of our social media channels. You'll see the Heritage Partnership on Facebook and LinkedIn, and our website is down below. I thank you very much, and have a good evening.